Okay, another weekly update of the rental house versus high income ETFs. Calling this season 2, episode 8. Little subtitle down here called Slow Going because things are going slow. So, quick recap, we sold most of our rental properties. One of the last properties we sold, November of 2024. We took the proceeds, about $70,000, and put it into a Robinhood account and invested it into some high income ETFs. And using a little bit of margin, I guess that would do a whole lot better than what the rental house would do if we would have kept that. And this series of videos is to compare things and show how things are going if we would have kept that house. So we sold the house, but if we would have kept it, I'm using projected numbers to show how that is doing. Don't forget to subscribe, and this is not financial advice, just me being reckless with my money and could be called bad advice. And quickly, let's look at the S&P 500 for the past week or two. Actually, this goes back 6 months, but I like to see how that's doing overall compared to this experiment to see if I'm kind of on pace, how things are going. So it looks like the S&P is slowly climbing back up here and continuing this long bull run it's been on. However, there's more tariff news that's affecting things, so we'll see how Monday goes. But the news actually came out during the market on Friday and didn't really affect things really that I could tell, but we'll see. So this is my account. Well, the balance, if I sold everything and threw my hat in and quit today, I'd end up with $89,000. So I am using some margin, and my margin has gone up, and I don't like that. It's at $82,000. Because what happened was I had these options on SoFi, and SoFi took a dip. The option expired, so I ended up having to buy some shares of SoFi. So I have 800 shares of SoFi worth $15,000 right now. And actually, I ended up paying close to $20,000 for the SoFi because of the option. I did collect some option money along the way, so I'm not exactly sure what the basis is on that. I have to figure that out. So these are the current options I have out there right now. I have a cover call on 5 contracts of SoFi, and then I have some cash card puts on the double leverage Amazon and 1 contract on TQQQ that are set to expire about a month from now. And these are the other shares I have of ETFs here and the balances of all those. So all these here pay a weekly or monthly distribution, and that's how it pays down the margin. And then I saw these cover calls on these stocks or ETFs, and I use that money to pay down the margin. Like I said, what I wasn't counting on is getting assigned shares of SoFi and having to buy those. But that's the danger of selling options. Remember, this could be bad advice. So off to the next slide. So what happened this past week? So I earned quite a bit of money from our distributions here. So starting at the top here, on Monday, we'll collect $145 from MAGY. And then we have QDTE. If you've been watching these, you remember that QDTE has been all over the place, really low, really high. Last week it was 112. This past week it was 216. So I don't know where it's going to settle in at. I figured it'd be about $150 a week on average. So we'll wait and see. The important thing is that the total return stays somewhat consistent, and we'll look at that in a minute. Then we got distribution from SPYI, QQQI, and those pay monthly. TDAC, that pays monthly. We got $500 from that. And last week we got distribution from MAGY that pays weekly, and then QDTE last week. So MAGY and QDTE pay weekly. All the rest of them pay monthly. And the SoFi stock that I got does not pay a dividend. At least I don't think it does. If it does, it's only pennies. What I'm counting on that is to appreciate and then sell cover calls as it slowly appreciates and make money on the way back up. But right now, the price is low enough where there's not a lot of money I can make selling cover calls at what I paid for it. I'm just going to sit on those for a few weeks probably and not make any money off of them. And I don't like not making money. So speaking of premium, so making money off this account 2 different ways. The distributions from the ETFs and the option income. So this is the income I've made off the options, and this line here separates the month. So where this line is starting February. So in February, I highlighted these here. I've actually made $1,376 in option income. Of course, I had to buy those shares at a discount. I bought some at $24. I bought some at $26. So the average is right at 25. But then if you subtract off the premium I made from what I paid for the stocks, that cost basis is lower. And I don't know exactly what that is yet. I could do some math and add that up and subtract it, but I didn't do that yet. We'll wait and see. So I got an option out there for 23, which is actually about the cost basis of that first group of shares that I bought. I'll make money off that when I close that here in the next few weeks. That expires on March 6th, which is I think 2 weeks from now. And the second way I make money off this account is from the distributions from the ETFs. So we already kind of looked at last week, but this is for the whole month. You can see how things are going. And I do pay interest on the margins. That's another reason why I don't want the margin getting too high, because I don't want to pay interest on it. I was expecting to make about $4,000 this month, and that's about where I'm going to end up. And here's that option income. I just put that in here at the bottom rather than putting each contract individually here. I just kind of group them together. So next week I'll collect probably about $600 from AIPI, and then QDTE maybe like 150. So this will jump up another 750. So that will put us right about 4,000 for the month, which is actually a little bit more than what I was expecting. I said that I was expecting about 4,000. I wasn't expecting to make this much in the option income. So we'll keep moving on here. So this year I keep track of like what I've been buying. So earlier in the year I bought TDAC when it took a dip, and I'm happy with that purchase. It's doing fine. But then these are the SoFi shares that I bought by being assigned when the options expired and my price was below the strike price. Like I said, I ended up buying 800 shares total, and the average price will be $25. So these here are the tickers for all the ETFs that I'm owning in this account. And this is the total return since the 1st of January. You can see the SPY is actually up a little bit, and you would think that SPYI would be up a little bit too, but it's not. So the thing that I like to watch is how things are doing based on the underlying. So I have SPY and QQQ in here to compare things to. So I compare QDTE to QQQ. So you see QDTE has lost 1.52%, and QQQ is minus 1.41. So it's pretty close to being about the same. But QQQI is actually doing better than QQQ, so I'm happy with that. And TDAC is right about exactly the same as QQQ. Now, what I'm not happy about is MAGY down almost 5%, and AIPI. So AIPI is an index of AI stocks, and MAGY is the Magnificent Seven. When there was earnings, Microsoft and Amazon both had disappointing earnings, or the stock kind of declined, pulled back quite a bit when they had earnings. So I suspect when Amazon and Microsoft climbs back up to where it was before, this here will climb back up and I should be fine. And I have confidence in the Magnificent Seven stocks that they don't stay down forever. They do go down, but they come right back up over time. Remember, this is all my opinion, and don't follow my advice. So this is the chart where I projected things from the very beginning of the project. So this over here is all projected, and over here is what's actually happening. So I don't know why things can't go as projected, but it doesn't. So right now I would have projected I'd be sitting at 100,000. I'd be using 60,000 in margin, and I'd be up 6% for the year. And I'd be using 60% margin compared to my equity. So this number right here would be 60% of this number right here. About over here is how things are actually going. And up here, things were actually going quite well. And then things kind of took a little bit of a nosedive here, but they are what they are. And it's okay. I'll show you why it's okay here in a few minutes. But I'm sitting at 89,706. This is the margin, so I don't like that being up there because I had to buy that SoFi for 20,000. You can see it's about 20,000 more than what the low point was. So hopefully SoFi climbs back up. I can sell cover calls on the way back up and reduce this down. And then when SoFi gets up to about what I paid for it, around $25 per share on average, I'll sell those and then reduce this back down. So that's the plan for that. And you can see I'm up 2.4% for the week, and for the year I'm down almost 6%. I'm using 92% margin instead of 60%. Now, I'm not panicking about this. So this is my number. This is not like Robinhood's number. Robinhood's number says I could still borrow a lot, which I don't want to borrow a lot. And let's see here. So I have available 136,637 in margin that I could be using, and 41,000 available about when you add in the option collateral with the option used. So the option collateral is the collateral I'm using for these options right here. I don't pay interest on that unless I buy those shares, and then that there would move up to this column here. So I don't want to get assigned these shares here. So what I'm going to do with these here, instead of getting assigned, like I let myself get assigned these shares, the SoFi. That was okay. But I don't want to buy any more shares. So if this price does not move in my favor the next month, what I'll do, I'll just move these options out a month. It's called rolling them forward. I'll roll those forward, basically extend the expiration dates, and then probably collect more money. And I do that to keep from getting assigned more shares. So this will stay the same. So last thing here, this green line means this is where I expected my margin to be at about a 50% ratio. And at that point, my plan was to then start buying more things to this account. This margin is slowly getting paid down each week as I collect those dividends and option income. And the reason why it went up is because obviously I bought those shares of SoFi. So this is all about comparing to the rental house. So if I would have kept the rental house, the balance in the checking account would be like right here, and the equity would have grown because I'm figuring a 4% equity growth. So if I had that house and were to sell that today, it would be around 78,500, and that's just an estimate. And I have my expenses right here. So the expenses actually came from my tax returns for the past several years. So this is real numbers, and average almost $370 a month. And the other thing I did not include in any of these numbers really was all the money we spent to fix this up before we sold the house. So we spent $15,000 about to fix the house up. So we sold the house for $85,000, and we figure in this $15,000, that's why I come up with the $70,000 net approximately, because I want to recover this money before we sold it. Now there was some realtor fees and some other little miscellaneous things, but 70,000 was a nice even number. And when you do the math, this is the rental house, 78,570. This is my ETF. So today the ETFs are up 11,136. So even though the market is kind of like blah, I'm still doing okay. Now I really expected this to be at 100,000. So I expected this number to be about double that, but we'll get back there. I have confidence. And that wraps up this week. So remember, if you like this type of thing, make sure you subscribe and like the video and do all those cool things that YouTubers tell you what to do to make their channel grow. So we'll see you next week.